Since a couple of years now, John has been able to set aside a part of his salary for a rainy day. But with interest rates below inflation, his savings account at the local bank is fast losing its purchasing power. Now, with a stable salary allowing him and his partner to put aside a monthly amount for their retirement, John decided that the time has come to make his hard-saved money work for him and to invest for the future. Unfortunately, his bank and pension savings won't cut it. John recently learned that, as the baby boom generation retires and life expectancy in Europe continues to increase, coupled with the fact that fewer babies are being born, Europe's population is aging and that there is a growing number of older people living off a state pension, with fewer people of working age actually paying for it, ultimately leading to inadequate pensions upon retirement that too often won't protect future pensioners from old age poverty. So John would have to look for other ways to build a nest egg and find alternative solutions to provide for a decent income through retirement. But where to start? John, of course, heard of the two basic building blocks of investing: shares and bonds. Late-night conversations with a friend, Jane, who recently started working as an investment advisor in a bank, also gave him a decent grasp of what shares are and how to invest in them.
You see, John, if you own a share, you own part of a company and a share in its profits through dividends. But you also take on risk. If the company does well, you get to share in the growth of the company through an increase in the price of the stock. But if the company does not do so well, you don't make any money, and the price of your stock will go down. In any case, investing in equities can be very rewarding because it allows you to profit from the growth of companies. But it does come with a risk, especially if you invest in just one or a few shares.
Over the years since that conversation, John dabbled a little in shares with mitigated success. Even though his shares performed better than his savings account did, he had lacked the time and expert advice to get the most out of his investment.
So yes, investing in shares is a great way to build up a nest egg. But beware, John, since each share comes with its own risk, you need to spread your risk over many shares. And this can be very time-consuming. Ideally, you will also complement your portfolio of shares with less risky bonds. You see, with a bond, you make a loan to a company or government and take on less risk since you get interest on the money that you lent, or principal, and you get the principal amount back at the end of the set term. That way, you earn irrespective of whether the company does well or not, as long as the company does not go bankrupt.
John is apprehensive at the idea of following up on his friend's advice to also add bonds to his portfolio. What if he doesn't fare any better than he did with shares all those years ago?
Yes, I see how bonds are less risky than shares, and how they can limit losses when counterbalancing the higher risks that come with shares in a portfolio. Of course! By adding bonds to your portfolio, you don't put all your eggs in one basket, since you diversify by adding different asset classes and spread risk.
Wow, that was close. Yes, diversification is also one of the big advantages of investing in an equity fund rather than directly in shares, since you get exposure to tens of different shares in different economic sectors. And remember that in order to limit risk and diversify your investments, a mix of shares and bonds is the way forward.
But how much should I have of each?
Well, the ideal ratio between bonds and stocks in your portfolio will depend on a series of factors, but will mainly come down to individual risk tolerance and time horizon. Over long periods of time, say 10 years or more, shares have usually provided higher returns than bonds. As a rule of thumb, when starting, you may want to go for a fairly balanced portfolio composed of 30 to 40% bonds and 60 to 70% shares. You may then adjust this over time depending on your risk tolerance, but you should ideally never invest 100% in shares to protect against risk in case of a market crash. You seem overwhelmed, John.
Well, yes, I feel like we have barely scratched the surface of what there is to know about stocks and bonds.
Indeed, investing directly in stocks and bonds can be complicated and time-consuming, but that's where investment funds come in. Funds pool money together from a group of investors and invest that capital into different securities such as shares, bonds, money market accounts, and others. They offer investors a great way to diversify their holdings instantly, and this is done for you by a professional investor. Some funds pay regular periodic dividends. Other funds don't pay dividends and capitalize all income. In this way, the latter offer one of the easiest ways for investors to reap the benefits of compound return.
Compound return?
You know what they say, John, save early and watch your money grow. Well, the most compelling argument behind this adage is compound return. Compound return is dividends and/or interest earned on your original investment or principal and the accumulated growth in your account. In other words, interest on interest. To achieve compound return, rather than withdrawing the interests or dividends earned on an investment over 1 year, the return earned is reinvested and added to the principal, so that the following year the interest applies to the principal plus the dividends it earned the year before. By adding the returns earned back into the original capital investment, a fund's value grows at an exponential rate. For instance, if John had invested 10,000 euros on December 31st, 2010, in a fund replicating the Euro Stoxx 50 on December 31st, 2020, he would have had 12,866 euros if he had cashed in his dividends, 17,786 euros if he had reinvested them in the fund. This represents an annual pre-tax return of 2.55% in the first case, but of 5.93% in the second.
Compound return? What's not to like? Compounded returns, diversification, professional management, saving me a lot of time and efforts, and limited risk, all rolled into one. But how to choose the right fund?
So, to answer the question from our latest caller, John, on how to pick the right investment fund for you, I will now turn to our expert, Alice.
Thank you for your question, John. As you already correctly explained, investment funds are a practical, cost-efficient way to build a diversified portfolio of shares or bonds, spreading risk over a large number of individual company shares, company and government bonds, and other assets. If you invested in a fund, you would also benefit from the experience and know-how of a professional investment manager who manages the fund for its investors, so you don't need to pick your bonds, shares, and other assets yourself. But as you said, John, you still need to pick the right fund for you. Whereas in Europe, investors generally have to invest in funds via an intermediary, their bank or insurance company, and pay them fees. In Anglo-Saxon markets, investors can invest in funds directly by opening an account at the fund management firm. Many banks offer their clients the possibility of investing a small monthly amount in an investment fund. This is an excellent way to invest through the up and down movements of stock markets, to start saving at a young age and compound investment returns over a long period.
That sounds great, Alice. So, what should John be paying attention to when buying into a fund?
Well, first of all, John would need to get to grips with the notion of the net asset value, or NAV, per share. The NAV of a share in an investment fund is the sum of the financial value of all the fund's assets divided by the number of the shares issued by the fund. When investing in a fund, John will buy the shares at the NAV at the time of purchase, plus frequently a sales charge called entry fee. When selling his shares, he will usually get paid the NAV at the time of sale. The change in NAV between the time of purchase and the time of sale, minus the sales charge and the ongoing expenses of the fund manager and its service providers, represents John's profit or loss, since the change in NAV can also be negative.
Yes, but as you have told our viewers many times before, over longer periods of time, financial markets have historically returned positive returns, right?
Yes, indeed. The annual Global Investment Returns Yearbook from the London School of Business, the reference on historical long-run returns, shows that over the last 120 years, global equities have provided an annualized return after inflation of 5.2% and 2% for bonds, before any fees or charges, of course.
Thanks, Alice. So, John, are you more confident about investing in funds now?
Yes, somewhat, but I still feel rather confused with all the different types of funds out there.
Right, it does get a little bewildering with the different names and terminologies. Just know that investment funds are known as mutual funds in the US, unit trusts in the UK, and open-ended investment funds, SICAVs, or Fonds Communs de Placement, FCP, in Europe. Other funds also exist, whereas most funds are open-ended, meaning that investors can buy directly into the funds by paying the net asset value, the NAV, for the shares. Some investment funds, closed-ended investment companies, are listed on a stock exchange instead and are generally bought on this market at a price determined by supply and demand. And investment trusts are different from exchange-traded funds, ETFs, which are funds that replicate a specific index, that is to say, a specific equity or bond market, such as, for example, the 50 biggest stocks in the European market, usually without pursuing an active investment strategy, and that can also be bought on a stock exchange. The different types of investment funds are defined by the assets they invest in: equity funds, bond funds, money market funds, or real estate or property funds. Funds are further differentiated by the geographical areas they invest in, such as developed markets, emerging markets, regional or country funds, or by economic sectors, such as healthcare, finance, energy, or consumer products.
Well, that's quite the list. How should John go about navigating this, knowing there are about 30,000 funds in Europe alone?
Well, the best would be for John to get advice from a preferably independent financial advisor who will be able to help him determine the types of funds that are most suitable for his financial goals.
Okay. Any other last tips for John?
Well, we barely touched on what is perhaps the most important part of investing in funds: the fees. You see, John, you can invest all you want. If the fees you pay are too high, they will eat into your returns and perhaps even destroy the initial value of your nest egg. In other words, your savings. Costs are one of the main factors determining future returns of investments. So, when investing, pay attention to the commissions or sales charges charged by the fund. These are generally between 0 and 5%, but as a rule of thumb, I would not recommend investing in equity funds with annual charges above 2% and 1% for a bond fund. It is important to know that independent research clearly shows that, on average, the most expensive funds actually perform the worst.
Thank you, Alice. So, that's all we have time for. John, I hope this was useful for you. Till next time.
For more information on how to invest in funds, visit www.investis.lu, www.betterfinance.eu, and www.f2ic.fr. All investments carry a risk of loss. Past performance is no guarantee of future performance. The video is the intellectual property of Investis, Better Finance, and F2IC, and may not be copied in whole or in part without the appropriate referencing.